What if I told you that you could see the next recession coming? And what if you had a plan, not just to survive it, but to actually come out ahead? Well, today we're diving into the playbook of self-made millionaire Mark Tilbury to figure out how to turn a market reset into a massive opportunity.
You know, it really all boils down to perspective. When you hear the word recession, do you see a crisis that you need to be afraid of? Or do you see a rare chance to build some serious wealth if you just know what you're doing?
Okay, so let's start with the one big idea that kind of changes everything. This concept of a market reset. Once you really get this, I promise, you will never look at a market downturn the same way again.
This is where you see the huge gap in mindset. For most people, a recession means scary headlines, panic, and loss. But for investors like Mark Tilbury, they see a massive sale. It's like walking into your favorite store and seeing everything you want is suddenly 50% off.
So a market reset isn't some kind of disaster. It's just a natural part of the cycle. I like to think of it like a forest fire. It sounds scary, but it clears out all the old dead wood and makes way for new growth. All those inflated prices come crashing back to earth, and that creates this incredible chance to buy great assets at a huge discount.
Okay, so that all sounds great in theory, but why now? Why is this all happening? Let's take a look at the economic gears that got us here. Mark Tilbury has a really good way of explaining this.
He compares the economy to a video game. For the last few years, we were all playing on easy mode. You had stimulus checks, super low interest rates, pretty much everything you bought just went up and up. But now, oh yeah, the game has been switched to very hard mode.
So how do we get into hard mode? Well, it all started when government started pumping tons of money into the economy during the pandemic. But here's the thing, when you have way too much money chasing the same amount of stuff, well, that's the classic recipe for inflation. To cool things down, central banks really only had one move. They had to start raising interest rates.
And the problem was huge. I mean, huge. In June of 2022, U.S. inflation hit a staggering 9.1%. That's a level they hadn't seen in 40 years. The price of everything, from gas to food, just exploded.
And this wasn't just a U.S. problem. No way. It was happening all over the globe. In that very same month, Thailand saw its own inflation rate hit 7.66%, which was a 13-year high for them.
So the response had to be just as dramatic. The U.S. Federal Reserve slammed on the brakes, raising interest rates by 0.75% in a single go. That was the biggest single jump they'd made in almost 30 years. The message was loud and clear. The party is over.
And that one move creates this massive ripple effect. See, higher rates make it more expensive to borrow money. So what do people and businesses do? They spend less. That, of course, hurts company profits. And when future profits look weak, stock prices fall. And just like that, you have a market reset.
Okay, so we know what's going on and we know why. Now let's get to the good stuff, the actual plan. This is Mark Tilbury's 3-step playbook for not just surviving, but actually winning a market reset.
But wait, before you even think about investing a single penny, there's one thing you absolutely positively must do first, and that is build an emergency fund of 3 to 5 months of living expenses. This is your financial armor. It's your safety net. It means if you lose your job or have an emergency, you won't be forced to sell your investments at the worst possible time. Do not skip this step.
All right, with that safety net secure, you are ready to play offense. Step 1, start stacking cash. Just build up your reserves and be patient. Wait for the dust to settle. Step 2 is what he calls the YOLO move. This is where you take a big chunk of that cash and invest it when you think the market has hit rock bottom. And finally, step 3 is slow buying, or what a lot of people call dollar cost averaging. That's where you invest a little bit at a time, every week or every month.
So, which one is right for you? Well, the YOLO move is your classic high-risk, high-reward play. If you time it perfectly, you could see some absolutely massive returns. But if you get it wrong, you could lose big. Slow buying, on the other hand, is the much safer bet. You probably won't buy at the absolute perfect bottom, but by investing consistently, you average out your cost over time. This takes a lot of the guesswork out of it and helps you build wealth steadily.
Okay, so you have your strategy, you know how you're going to invest, but now the big question is, what exactly should you be buying when the time is right? Because what you buy is just as important as when you buy it.
Tilbury's advice here is to keep it simple and stick with quality. For him, that means two main things. First, index funds, like one that tracks the S&P 500. That way, you instantly own a tiny piece of 500 of the biggest companies in America. Second, he buys individual stocks in strong companies that he truly believes in for the long haul. The key here is what to avoid. All those small, super risky, volatile companies that might not even survive a recession.
You can really see his approach to risk when he talks about something as wild as crypto. He's not out there gambling on a dozen different meme coins. No, he sticks to the big dogs, Bitcoin and Ethereum. But here's the most important part, the golden rule. He keeps his total crypto investment under 10% of his entire portfolio. That's a calculated risk, not a blind gamble.
You know, this might just be the most important rule of all. Invest with what he calls cold money. That is, cash you are 100% sure you will not need to touch for at least the next 10 years. In investing, time is your single greatest ally. It gives the market time to recover, and it gives your investments time to compound and grow.
So, when you put this all together, what's the big takeaway? It's that recessions aren't something you need to be terrified of. They're normal. They're a predictable part of the economic cycle. Think of it as a reset, a necessary pause before the next big wave of growth.
So I'll leave you with this question. The next time the headlines are screaming about a market crash, and trust me, there will be a next time, what are you going to see? Will you see a crisis to run away from, or will you see the investment opportunity of a lifetime?